So in this question of Pricewell, this is a question on single company accounts in which you have been asked to prepare the income statement and the balance sheet. As you can see in the requirement, that's to prepare the statement of P&L and OCI for the year ended 31st March 2009, and also to prepare the statement of financial position as at 31st March 2009. Okay. So before you attempt this question, there are a couple of standards which you need to go through first, and then you can attempt this question. So the standards, what this question is based on, and a test is basically IAS 16, which is more or less the concept of depreciation and the revaluation. Okay. Then you also have IS 36, which is impairment, and specifically case of a reversal of impairment. Okay. Next, you also have about IFRS 16, which is the leases, right? You also have IFRS 15 covered up in this question, revenue recognition. So it's normally the the construction contract and the agent relationship. Okay. So if you are an agent, right? So that's also covered up in this question. And the last thing what we have is IS 12, which is about taxes. Okay. So income tax and deferred tax. So if you are thorough with these standards, I mean, you can solve this question, right? So now let's try to solve out this question. Okay. You can see that they have provided you with a trial balance over here, right? And after the trial balance, you have the following notes which are relevant, talking about all the relevant standards. And then you can make up your income statement and balance sheet. Now, before you start the question, you always have to make sure about the dates. Okay. So dates are very important. Now, here we do understand that our year end is 31st of March 2009. Okay. So please do write down the dates so that you don't forget about them. Okay. Because dates would be very important while you're attempting the question. Now, let's read the first point. I would rather advise that you start your workings first, and your working starts from the notes. Okay. And then you can go on the next step in which you will actually make your income statement and the balance sheet, right? So the first working what we have here is about the non-current assets. Okay. So this one, it says the 15-year leasehold property was acquired on 1st of April 2007 at a cost of 30 million. Okay. So now when you're reading the notes, you basically need to connect this uh, with your data in the trial balance. Okay. So here you can see that you have the leasehold property, which is at a valuation 31st March 2008 at 25.2, right? So in this case, now if it's written at valuation, this means that this asset has been revalued previously. Okay, but on the other hand, if it's written at cost, it means that these assets are to be recorded at the cost model. Now, this leasehold property is at a valuation of 25.2 at 31st March 2008. We need to bring it up to 31st March 2009, right? So here, so the first working what we have is for the leasehold property. Okay. The 15-year leasehold property was acquired on 1st of April 2007. Now you do understand that this is like 2 years before your reporting date, okay? Because your reporting date over here is 31st of March 2009. So this is like 2 years before at a cost of 30 million, okay? So we just put million. The cost of this leasehold property was 30, and that's like on 1st of April 2007, right? So as the life is 15 years, right? So in the first year of this asset, you would have charged a depreciation of 2 million, right? So that's 2 million depreciation that you would have charged in the first year. So the net book value of this asset by the end of the year will be 28, correct? And they have given you over here that the accounting policy is to revalue the property at fair value at each year end. So that's the fair value 1 year before, right? So that's basically on 31st of March 2008. So the fair value at that date, yeah, the valuation in the trial balance of 25.2 as at this date led to an impairment charge of 2.8 million. So what are they trying to tell you is that the fair value at that time was 25.2, and that's the value they have given to you in the trial balance also. Here, see. Leasehold property at a valuation of 25.2. So that was the fair value last year. Okay. So 28 was the net book value, but then it had a fair value of 25.2. So this means that you had to reduce down the value and there was an impairment charge. Okay. So the asset has been, there has been an impairment on the asset, right, of 28 minus 25.2. So you get an impairment charge over there of 28 and 2.8, sorry. And this has to be recorded in the income statement, right? Because if the first time, in case if there is any impairment on an asset, you have to record it into the income statement as per IAS 36. Now, the question is that how you're going to record it in this current year, okay? So now the fair value, so this was for the first year, right? Now we're going to be talking about our year. So when we start our year, the fair value of this asset, okay, that's on 1st of April 2008. So the fair value at this date is 25.2, right? And now you can understand that there is a remaining life of 14 years, because from 15 1 year, the last year has passed, and now it's a life of 14 years more. So the depreciation which you will charge for the current year will be 25.2 divided by 14. So it's 1.8 million depreciation charge for the current year. Now this 1.8 will be a part of your income statement. So I'm highlighting it over here. So in case I don't forget, okay? So 25.2 minus 1.8, you will get the net book value of this asset by the end of your year, which is 31st of March 2008. So 25.2 minus 1.8, the net book value is 23.4, right? So now you can see over here The valuation in the trial balance of 25.2 million at this date led to an impairment charge of 2.8, which we also calculated, which was reported in the statement of P&L and OCI. Fine. At this date, the closing date, the property was valued at 24.9 million. So as per our calculation, the net book value is 23.9. But in case as we have a policy of recording it at the revaluation model, okay, we have to bring it to its fair value, which is on 31st of March 2008. So the fair value given to you in the question is 24.9. So this means that we can, there's a reversal of impairment over here. Okay. Like the value of the asset has gone up now. So in this case, uh, there is a surplus of 24.9 minus 23.4. So there's a surplus of 1.5 actually. Okay. Now we have already recorded an impairment of 2.8. So now when there has been a reversal of impairment, right? First we need to charge it to the income statement, uh, and then the extra we have to record it in the OCI. So till 2.8 of surplus, if it would have been, I would have recorded it into the income statement, and then the extra uh, amount surplus, I would have taken it into the OCI. But in this case, this revaluation surplus will be recorded into the income statement as a reversal of impairment. You also have to be careful that, see, when there is a reversal of impairment, you need to check with this rule that the asset cannot be revalued at a higher amount than it would have been if the impairment would have not been charged on the first place. Okay. So on this leasehold property, right? On this leasehold property, if I wouldn't have charged the impairment, then in that case, the value of this leasehold property would have been 30, right? Minus you're charging a 2 million depreciation every year. So in 2 years, there would have been a total of 4 million depreciation, right? So that is 30 minus 30 divided by 15 into 2. So if the depreciation would have, sorry, if the impairment would have not been charged in the first place, then in that case, the value of the asset would have been 26. Okay. But right now I'm just bringing it to 24.9. So it's fine. I cannot increase it more than 26. Okay. If the fair value of this asset would have been 27 actually, I could have not increased it more than 26. So the rule is when you want to reverse the impairment, you you cannot increase it more than the value of the asset if the impairment would have not been charged in the first place. Okay. So if I wouldn't have been charging impairment on this asset in the first year, so by the end of the second year, the value of this leasehold property would have been 26 million, right? So the point is that I cannot increase it by more than 26. In this question, they just have given you a fair value of 24.9. So which is fine. I mean, you can increase it till 24.9. But in case if the question would have been that the fair value, the property was valued at 27 million. So the point is that you cannot increase it up by more than 26. Okay. In that case, the maximum reversal what you could have bought will be the difference between 26 and 23.4. right? So that's going to be 2.6. So that's the maximum limit. And whenever you are reversing the impairment, first you have to charge it into the income statement, and then the extra amount, the excess, would have to be recorded in your OCI. So here, because we have 2.8, right? So till 2.8, we can charge it into the we can charge it into the income statement, and after that, in case if there would have been any extra in case if there would have been any extra surplus, we would have recorded it in the OCI. Okay, right. So this surplus of 1.5 will be in your income statement. Okay, correct. So now let's move to the next point, which is own plant is depreciated at 25% per annum using the reducing balance method. Okay, so this was for the leasehold property, and now we have for the owned plant, which you have to depreciate based on reducing balance method. So in that case, we charge the depreciation on your net book value. So for the own plant, you see the cost is 46.8 million. Okay. And there has been an accumulated depreciation on this own plant and equipment of 12,800. So this is in thousands, right? So the accumulated depreciation, what you have is 12,800. So the net book value at the start of your year, which is 1st of April 2008, would be 46,800 minus 12,800. So it's 34,000. And the rate of depreciation, what they have provided you is 25 percentage per annum using the reducing balance method. So depreciation, again, I need to bold it. So depreciation charge for the year would be 34,000 into 25%. So that gives you 8,500 or 8.5 million, right? So now the net book value at 31st March 2009, that's your reporting date, would be 34,000 minus like 34 uh, million minus 8.5 million. So that's 25.5 million for your own plant. Okay. So that was just a simple calculation for reducing balance method on reducing balance method for your own plant. Now we have for the leases, right? So the right of use plant was acquired. So this point is basically about lease. Now, before I jump into this point, you do understand that the lease liability has to be recorded at the present value of the lease payments. Okay. So we'll move now to the next one, which is right to use the asset. So the right of use plant was acquired on 1st of April 2007. So this is again like 2 years before your reporting date. Okay. So 2 years before they entered into a lease agreement. The rentals are 6 million per annum for the 4 years payable uh, in arrears on 31st of March each year. So you don't have to pay it on 1st of April in advance, but later during the end of the year. The interest rate implicit in the lease was 8%. Right of use plant is depreciated over the lease period. Fine. So now, as I explained you that whenever you have to write down the lease liability, you have to record it at the present value of the future lease payments, right? So in future, basically you're starting the lease on 1st of April, but in future you have to make a payment of 6 million for 4 years. Okay, so we can use the annuity, or you can see first year, second year, third year, fourth year. So every year you have to pay 6 million, 6 million, 6 million, and 6 million, right? So that's your future value. Then you can take the discount rate, which is going to be at 8%. Okay, and if you multiply with it, you will get the present value. And once we total it out, we get the initial value at which you have to record your lease liability. Okay, so here you go. So this would be 1 divided by 1.08, right? So yeah, this divided by, again, 1.08. So that's the second year factor, and I can keep on doing it for the third and fourth. So for present value, you have 6 multiplied by this. So it's better that, if the question is in thousands, so let's go in thousands. So it would be quite easy for us. So yeah, so this is all because we're talking about 6 million. So this is basically all in thousands. So if the question is also going in thousand, it's better that you also go in thousands. Okay. So now the total value over here would be 19872. Okay. That's the opening balance of your liability. So when you're going to be recording it, but like you can round up these to, oh, okay, let's forget about it. Anyways, so here the initial entry would have been 19872. Okay, so as you know that debit would be right to use the asset, and credit would be lease liability. Okay, so let's deal up with the lease liability first, and then we can talk about your right to use the asset, right? So this is the starting. So here you have the opening balance, then you have the finance cost, the interest rate at 8%, then you have the payment, and then you have the closing balance. Okay. So your liability is 19872. So this balance is basically on 1st of April 2007. Correct? Like that's basically the first year, 2 years before your reporting date. Okay. And on this you have to charge 8% interest. So the last year the interest what was being recorded was 1589. Then there was a payment of 6,000, which gave you a closing balance. So this plus the finance cost minus the payment, you get the closing balance, right? Now, if you look up over here in the trial balance, they have given you the lease liability at 1st of April, which is your opening date at 15,600. So we are getting 15,462. It's just because like we have like I have round up the figures over here. Okay. So let me just show you, because in your syllabus they take 2 3 decimal places, right? So here we go. It's going to be exactly what we found right now. Okay. So I'm just trying to prove the point. So in like I'm just trying to verify the figures for you also. So you understand that how those figures in the trial balance have been derived out. So it's something like this. Okay. So we can, right. So this one closing balance is 15462 as per the actual calculation, but like they have given you around 15,600. Okay, so it's just a round up difference over there. So now in the case of exam, obviously I would ask you to take that 15,600 as the opening balance. However, my point was to make you understand that how you are supposed to verify all these workings out actually. Okay. Yeah. So here we go. And if you can also see that the right of use asset at cost is 20. So instead of 19,873, they took 20,000. Okay. So these are what they have round up actually, but you can see the actual answers over here. Right. So on 1st of April 2008, okay. So this is basically, it's up to you. Like either you take 15,600 or you take 15,456. But anyways, I'll take 15,600 over here, right? And on this, you have to apply 8%. So that's basically going to be in your income statement. So this finance cost, that's 1248. This will be a part of your finance cost in the income statement. And then there has been a payment again of 6,000 by the end of the year. Okay, so that's just like a cash transaction. Here, see, these payment paid on 31st March 6,000, so that's 6,000 over here. And lastly you get your closing balance, so which is this plus the finance cost minus the payment, so you will get the closing balance. Now a lot of students will just leave the working till here. Okay, you just need to go one step ahead, because we need to segregate between our current and non-current liability, right? Because this liability is purely non total liability. From there, we have to segregate that how much would be our current and how much would be our non-current liability. This 6,000 is actually going to be a part of your cash flow statement, and this closing balance is actually a part of your balance sheet, right? But I just need to do it for the next year so that I can figure it out. I can separate it between my current and non-current liability. Okay. So again, you have to bring this 10,848 here. You charge uh, the interest again, which is at 8%. Then you do a payment of 6,000, and then you will get the closing balance. So which is 10848 plus 867.64 minus 6,000. So in that case, you get 5715. Okay. So now this 5715 would be considered to be as a non-current liability for my second year. Okay. So whatever liability is after 1 year, that becomes non-current for you, and the difference between them will become the current. So because right now we are at 31st March 2009, right? So whatever liability is left after 1 year, which is 5715, will become current for the this year, which you are ending and which you're talking about the reporting date. And the difference between them will become the current one. So non-current is 5716, I would say. Okay. This is non-current. So you just need to calculate the liability which is still remaining after 1 year from your reporting date, and that will become non-current for you in this period. So that becomes your non-current liability, right? And the difference between them, which is 10848 minus 5716, so that will become your current liability. Okay. Now as we have dealt up with our lease liability, we have to figure out for the right to use the asset, which you know that will be depreciated. Okay. So for right to use the asset, we need to depreciate it by 4 years because that's the lease term, right? The right of use plant was acquired on this, the rentals are this for 4 years payable, the interest rate is this, and it's depreciated over the lease period. So the lease period is basically 4 years. So the right to use the asset at cost was 20 divided by 4. So every year you get a 5 million depreciation. So the carrying value of the right to use the asset would be 20 here. That was the cost, correct? 20, then minus 5, which is the accumulated, and then again minus 5, which is for the current year. So that's the carrying value for the right to use the asset. And by this, we have completed with your non-current asset part. Now, the second part, what we have, okay, is the IFRS 15 over here, which is for the construction contract, right? So now we just need to complete our workings, and once we have all our workings, we just have to put it into the income statement and the uh, balance sheet. Now, here, if you see, on 1st of October 2008, that's like 6 months before your year end, the company entered into a contract to construct a bridge over a river. So it's a construction contract. You have to make a bridge over a river. The performance obligation will be satisfied over time. Now, you do understand that in IFRS 15, either the obligations are satisfied at a point in time. So that's like, let's say if you want to buy a book from me, I give you the book and you give me the money, and once I've delivered the book, I can record it as my revenue, right? Though you give me the money or you don't give me the money, but that's at a point in time when the obligation is fulfilled at a specific time period. Okay, but in case if it's done for over a period of time, then the revenues has to be recorded over the period of time, no matter if you have received in advance or you haven't received any money. Well, the agreed price of the bridge is around 50 million, and the construction was to be completed on 30th September. Uh, it's going to be 2010, like after 2 years, basically. The 14.3 million in the trial balance is made up of material, labor, and overheads of 12 million, specialist plant acquired on that date, which is 8 million, payment from the customer, which is 5.7 million. Now, the sales value of the work done at 31st March 2009, which is your reporting period, has been agreed at 22 million. So out of 50 million, 22 million worth of work has been completed. And the estimated cost to complete, excluding the plant depreciation, is 10 million. So 12 million has already been spent, and they expect another 10 million to be spent within 1.5 years. The specialist plant and will have no residual value at the end of the contract. So it's like 8 million, and that's specifically for this asset. And you have to charge the depreciation on a monthly basis. So it's going to be only for 6 months over here. The company recognizes progress towards satisfaction of the performance obligation on the output basis, not on the basis of the input, like how much money we have spent, but rather how much work has been satisfied, as determined by the agreed work to date compared to the total contract price. Right. So in this case, I would recommend that you do step by step. So here we have the revenue, the construction contract. Okay. First, we have to see that what's the profit overall on the contract. So we have here your contract value, which is 50 million. Okay. Now, cost incurred to date, which is basically 12 million. Cost further expected, which is 10 million. And then you also have a plant, right, for 8 million specifically for this asset. So the expected, like we are expecting a expected profit on this construction contract would be 50 minus 12 minus 10 minus 8. So we are expecting a profit of 20 million on this contract. So once when you have identified the expected profit on this, then the second stage, what you can simply do is that you can find out the percentage of completion. Okay. So that's going to be based on 22 because uh, that has been the sales value of the work done has been agreed at 22 million, right? Agreed work to date. So that's 22 million out of total of 50. So that gives me 44 percentage basically. Okay. So 44 percentage, that's the percentage of completion. So now when we are making up our income statement, correct? The revenue what we will record would be 50 into 44 percentage. So that's going to be 22 million. Okay. So this will be part of your income statement. You don't have to forget this. Then as far as the cost is concerned, okay, the cost what you have already incurred on this contract is 12 million, right? And there is also the plant depreciation which you have to record. So that's going to be 8 divided by 2 years, that's the life, multiply by 6 by 12 because it told you that it has to be prorated. So that's going to be 2. So the profit would be 22 minus 12 minus 2. Okay, so that's going to be 8 million worth of profit. And as far as your balance sheet is concerned, okay, so in that case, you have to see you have to see whether it's a contract asset or whether it's a liability. So in this case, for the contract asset, okay, so for the balance sheet, you can say that the revenue from customer, what is to date, that's 22 million, and the payment what you have received from customer is 5.7 million. So it creates a contract asset. I mean, they owe you the money. So it's an asset because you are expected, that's 22 is the work which has been satisfied. So from there, you just have received 5.7. So 22 minus 5.7, you will show up a contract asset of 16.3 million in the balance sheet, right? Now that's the end of the second point, and now we can move on the third point, which is the company's revenue includes 8 million for goods it's sold acting as an agent for another company. Okay. Price will earn a commission of 20% on these sales and remitted the difference of 6.4 million included in the cost of sales to Trilby company. So now this is something which you have done wrong. Like normally you get a question in the exam where the treatment is wrong and you have been asked to correct it, right? So I don't need to record the whole revenue of 8 million. That's against the principle of agent relationship, that you just record the commission, right? The rest would become a payable actually. So in this case, a price well revenue includes 8 million for goods. So basically, okay. So basically your share was 8 million into 20%. So 1.6. Okay. So that's your agent fees or commission, whatever. Right. So the remainder, which is 8 minus 1.6, you need to adjust. You need to remove it from the revenue because you cannot, it says includes 8 million. So you cannot include the whole 8 million. You can just record um, 1.6. Now you have an option that you can just remove the entire 8 million from the revenue and you can show 1.6 as your agent income as another income, or from the revenue itself you can also remove net, which is 6.4. Okay. And yeah, earned a commission on this and remitted the difference of 6.4 million to Trilby company. So they have remitted the difference of 6.4 million, which is included in the cost of sale, to Trilby. So that's also incorrect. So what you're going to be doing is that you will say debit revenue. Okay. So you need to reduce the revenue by 6.4 million, and you will also reduce your cost of sale with the amount of 6.4 million. So basically what they have done is that they have recorded it completely as its revenue, and they have recorded 6.4 million in the cost of sale, which is not correct. And what you have to do is that you will remove it from the cost of sale and you will also remove it from the revenue. Okay. Now, the last thing what we have over there is for the tax, right? So now for the tax, it says the last adjustment, which is for the tax. The last, it says the directors have estimated that the provision for income tax for the year ended 31st March 2009 is at 4.5 million. Now, this tax you will almost get in every other question. So the current year provision is 4.5 million. Okay. And yes, now see. Okay, I'm just coming back on this deferred tax, but here I will read it first. The balance of current tax in the trial balance represents the under or over provision of the income tax liability for the last year. So if you look up over here in your uh, trial balance, the current tax is on the debit side, which is 700. So it means that last year you had an under provision of 700,000. So this year you have to increase up your expense, because if it's on the debit side, it's considered to be as your under provision. So in that case, it will increase your current year expense. Okay. And yes, now we can talk about the deferred tax. It says the required deferred tax provision by the end of the year is 5.6 million. If you look up in the trial balance, it's 8.4. So from 8.4, it's coming up to 5.6, which is actually a decrease, right? So in case if it's a decrease, it will reduce down the expense. So we'll say decrease in deferred tax provision, which is 8.4, I believe. Yeah, minus 5.6. Yes, 5.6. So there has been a decrease of 2.8 over here. And so if it's a decrease, it will reduce the expense. So I'm putting it in negative, right? So this will give me a total tax expense of 4.5 plus zero point 0.7 and then minus 2.8. So that will give me a net tax expense of 2.4. Okay. And that will be a part of your income statement. As far as your balance sheet is concerned, right, you just have to record the current tax payable as a current liability, which is going to be at 4.5 million. That's current liability. And the deferred tax liability, that will be at the closing balance, which is at 5.6 in your non-current liability. That's all in this. So once we have finished up our workings, okay, which included your depreciation, your reversal of revaluation, your lease liability, then your construction contract to make a bridge on the river. You had an agency relationship over here, and you have your tax calculation. So once when it's done, now it's time to make up your the final format for the income statement. Okay, so 1 second. Okay, so once you're making up the income statement, right, first we have to just make sure that you mention the question number, which is A, part A. We will write down first the name of the company, which is Pricewell. Okay, we'll write down the second thing. What you have to do is that you write down the statement what you're making. So that's your statement of profit or loss and other comprehensive income, and lastly the period, which is for the year ended 31st March 2009. Okay, so that's the formatting, and you can go in thousands here. So that's the rough draft. We have the revenue, right? We have the cost of sales. It will give us the gross profit. We have the expenses. So you can see that you have here distribution cost and administration cost. Okay. Then you will get your operating profit. Then or PBIT. Then you have the finance cost. You will get profit before tax. You will minus the tax and you will get profit for the year. But in this case, I really don't think that we have anything to go into the OCI. So that's it basically. Okay. Now, as far as the revenue is concerned, okay. So as per the trial balance, what has been given to you is 234500. But if you remember that we had certain adjustments which we have to do, and that is The first one is that you had to remove the 6.4 million from here, because debit revenue means that you're reducing it as a revenue, right? You don't have to record this as a revenue. So we have to subtract 6,400 for the revenue of the agent relationship, and we also have to record this one, 22 million. That's for the construction contract, okay? Because that was not being recorded. Yeah. So that's 22,000, right? So this gives me a total revenue of 250, 100 actually. Moving further, okay. Sorry, the revenue is not, sorry, that was cost of sale. So the revenue over here is basically 310,000. Yeah, sorry. Yeah, so the revenue over here is 325600. Now, as far as the cost of sale is concerned, that is 234500 plus all your depreciation, because if you read over here, the policy was that no depreciation has yet been charged on any non-current asset for the year end, and that has to be charged in the cost of sale. So I'll tell you the depreciation what we have. The first one was this one, which was for the leasehold property at 1.8 million. Okay, so we need to add that 1,800. Then the next one, what you had was on your owned plant, which was 8,500. Okay. Then the next one, what you had was on your right to use the asset, right? Which was 5,000, I believe. Yep, right. Then you also had the reversal of impairment will also be to be recorded in the cost of sales. Okay, like it's because they are telling you that depreciation is charged to cost of sales. So anything which is related to the non-current asset, you can put it in the cost of sales. So because it's an income reversal of impairment, so I'm going to put it as a negative of 1,500 actually, right? And then for the this asset which we had, there was a 2 million depreciation, so that also has to be add up. So basically you have the depreciation, and then you have the depreciation, you have the reversal of impairment, and lastly what you have is basically the cost of sale for the agent. So we have to remove this 6,400, which by mistake we have recorded it in our cost of sale. So that will be a removal over there also. Okay. So in this case now I get a value of 243900. Okay, so you see that, so let's have a look. 234500, that was as per the question. Then 1800 is depreciation for your leasehold property. Then 8500 was the depreciation for the owned plant. Okay, 5,000 was the amortization for the right to use the asset. 1,500 is basically uh, for the uh, for the reversal of impairment. 2,000 was the depreciation for the this one, for the plant. Basically, what we can do is that for the contract, we can put 14, like 2 for the plant depreciation, yeah, and then 12,000 was basically the cost for the construction contract, 12,000 there, the material, labor, and overhead what you have spent. and 6,400 was the removal of the cost of sale from the agency relationship. So this gives me a total of 22,559,000, and my gross profit would be this minus this. So in that case, what I get is 69,700 as my gross profit. Distribution and administration, you can just simply copy paste from here. Distribution is 19,500, right? And the admin is 27,500. So this gives me my operating profit at this minus 19,500 minus 27,500. So you get 22,700. As far as the finance cost is concerned, do we have anything in it's just the lease liability what we have. We don't have any other loans. So uh, for the finance cost, we have to refer this, which is 1248. Okay. So that's the finance cost. Profit before tax would be this minus 1248. So you get 21452. Then you have the tax, which we have already calculated at, I believe, 2400 here. So 2400. So this gives me the final profit for the year for 19052. So that's the profit for the year. And once when we have made up the income statement, we can now proceed towards the balance sheet. Okay. So again, it's same. Pricewell Company statement of financial position, right? As at 31st March 2009. So in this case now, again, we have to put the thousands. We have assets first, and in asset, you have your property, plant, and equipment. Okay. So, right. So in case of property, plant, and equipment, now see you have um, the leasehold property, which you valued at the year end of, if you go back to your workings, it was at a valuation of 24.9 million. So I'll take 24900, right? And then the next one, what you have is your owned plant and equipment, which is after the depreciation, it was 25,500. Okay. Then you have your this, well, I'll write it down separately, right to use the asset. Uh, then yeah, for the this one, the asset which you bought it for the contract. So that's going to be at 6,000 because 8,000 is actually the cost of that asset, but then minus 2,000 was for the depreciation. So that gives me a total of 56,400. But then I also have to record the right to use the asset, which was at 10,000 because 20,000 was the initial value and you have to depreciate it for 4 years. So every year 5,000 because 2 years have been passed. So this will give me a value of 10. So my total, I would say non-current assets are at 66,400. Then I have to talk about my current assets. And in current assets, the first one which you have to record is your inventory. Now here, if you see, your inventory at the year end is 28 1,200. Okay. Bank is still in positive over here, right? Bank 5,500, but we have a contract asset, so we have to write that. And we have your receivables also. So first we'll write down your receivables, which is basically 33,100. Then we have your contract asset, which was, we have to go back, 16.3 million. And we have bank balance also, which is at 5,500. So this gives me my total assets at 149,500, I suppose. Okay. After this, now we have to work out for your equity and liabilities. So first we talk about your equity. So we have your 50 cents a share at 40,000. So 50 cents ordinary shares, that's like around about 40K. And that's it. We have retained earnings. Okay. So retained earnings, which will be the opening balance. What you have of the retained earning is 44,100. You will increase it by the profit what you have calculated from the income statement. And then if in case if there are any dividends, which we can see that we have dividends paid of 8,000. So we can subtract that 8,000 and you will get your retained earnings, which is at the moment at 55,152, right? So that's all in your equity for now. But then you have your non-current liabilities and your current liabilities. Okay. So in non-current liabilities, you have the lease liability and you have your deferred tax liability. So the deferred tax liability, we already know that it went from 8,400, 8.4 million to 5.6 million, I believe. Yep. So we have to just bring it over here, which is 5,600 or 5.6 million. The lease liability, we have also segregated between current and non-current. So the non-current part was 5,716. I need to bring that. Okay. And as far as your current liability is concerned, you have your lease liability, you have your tax payable, and you also have your trade payables. So lease liability, again, we can go back to the working. Lease liability is basically, yeah, 5,132. So here we bring 5,132. In tax payable, you will just have to record the current provision, which is basically 4.5 million. So that's 4,500 over here. And trade payables, we have to find from the question from the trial balance, which is at 33,400. So if I add them up, you will get the total, which is the total equity plus your non-current liabilities and then plus your current liabilities. Okay, so I hope I've done it. So we have 40,000 over here. Okay, yeah, 5716 5600 5132 4,500, and I messed up with my trade payables. That's fine. We just add this and that's it. And we got 149,500, which is balanced in this case. Okay, here. So that's my total equity and liabilities. Okay. I hope that question is clear. If you have any question, please feel free to ask. You can like, subscribe, and share. Thank you very much.